Hi, everybody. This is Bob Miller over at Mutual of Omaha Mortgage, and we're going to talk today about a program that can change your life. It will allow you to buy your next home for about half down and never have a mortgage payment. I know it sounds too good to be true. I hear that from everybody, but we're going to spend about an hour today learning exactly how this program works so that you have all the facts in front of you to make a good decision. First, a couple disclaimers. I am not an attorney and I'm not a financial advisor. I'm a licensed loan officer that does nothing but this program day in and day out. Mutual of Omaha Mortgage has a division that just does the HECM for Purchase program. What we're going to talk about here today is the new housing market. What happened in our country in 2008? Right, housing values plummeted. A lot of things plummeted, so we're going to talk about how we're going to protect ourselves against another housing bubble by using this program. We're wondering if it could happen again, and right now we're in a crazy market. It's a seller's market, and although we may not think it can happen again, it's best to plan in advance for any fluctuations the market might have. So I'm going to talk about how this program protects you from housing bubbles in the future. And during this program, you're going to hear me say HECM for purchase quite a bit. HECM comes from an acronym, the letter H standing for home, E is for equity, C is for conversion, and the letter M for mortgage. So it's the home equity conversion mortgage for purchase. You'll also hear it shortened to the letter H and the number 4 and the letter P, meaning HECM for purchase. We're going to talk about why you would consider using this instead of paying cash or securing traditional financing. And we're going to get into some of the details on how it works. You're going to understand by the end of this exactly how this program works. And by the time we're done today, you're going to be an expert. If you're not living in a dream home in retirement, what's stopping you? Some of the answers I get are financing a new home. They're overwhelmed about the things they have to get rid of before they can actually move, meaning that you have too much stuff. And in some cases, they just haven't decided where they're moving to or where they want to go. So we have some solutions for all this stuff and trying to get rid of stuff, and we have some resources that can help you that in all local areas. 2008 was an ugly year. I think we can all agree to that. There were some things that happened in there that I really, personally, I don't like what happened because I know probably a lot of you were like me. We lost a lot of money, both in our housing value and our portfolio in a short period of time, and started wondering what we were going to be doing for the rest of our lives and how much of an impact and how long it was going to take. We saw major companies declaring bankruptcy that we never thought was going to happen. And it was kind of unimaginable at that point in time. I know personally, my house went down 50% in value, and my portfolio went down, well, more than the 30% that's posted here. So, it was some scary times back then. And I think we all remember the day. It wasn't pretty. So the question is, where are we going to go from here? Home ownership. Is it an investment or is it a place to live? Well, in an ideal situation, it's both. But I think the biggest lesson we may have learned in 2008 is that we can't always count on that, especially in a shorter period of time. That may be in our retirement period. So I've actually had people say that they bought their house 20 years ago for $200,000 and they could sell today for $350,000. So they made a profit of $150,000. I suggest they take a pen and paper that and add up all the interest that they paid in the mortgage over those years and total up all the money they put into the house as far as improvements like decks and landscaping, new windows, maybe updated kitchen, bathroom, things that they're probably never going to get back out of the houses in addition to any maintenance that they put into. And what happens is most of the time the people put that into, they admit that they never really gonna get everything out of it they put into it, especially if it's a down market. But they enjoyed it while they lived there. So sometimes we have to shift our thinking that it's not always an investment, but it's always a place to live out the rest of our lives at the comfort level that we hopefully want. Now, the new housing paradigm, there's three different options that we have today. And let's go over the first one, which is paying cash. It's pretty simple. You have a purchase price of $350,000 and you lay out $350,000. The advantage is there that you don't have any monthly mortgage payments, you don't have any compounding interest, and you're going to see home appreciation still taking place. But of course, on the bad side, you're tying up all of your money into this property, and that's money that you don't have working for you. And on the bad side, also, you're not guaranteed growth in income. 2008 taught us that. So really at a point in history that we're in, what does the future hold, and where are we going to be 5, 10, 20 years down the road during our retirement? Because property could fall again for some unknown reason that we're not even anticipating right now. Now, option number two is the way that we all have grown up thinking. You go out there and you have a purchase price of $350,000, you put down 20%, and you have an interest rate, you have a loan amount, and you make some monthly payments. But take a look at that 5-year cash outlay. And in a 5-year period of time, you're going to be spending another $153,000 on it. Now, we all know that in a 5-year period, the first 5 years of a loan, you're mostly paying interest on that loan. So there's not too much of a principal reduction. But on the good side, you're not laying out too much cash, so you do have some cash that's working for you on the side because you don't have it all tied up in the property. And you do have some fixed monthly payments, so you know and you're able to budget yourself. And you're still able to take possibly benefit from any home appreciation. But of course, the bad side is that you do have monthly debt service, and you're going to have to be paying that whether you're going to be able to pay it out of savings or you have some existing cash flow. Maybe you're still working. Everybody's a little bit different. You do have that interest compounding, and you're still having to pay it. Now, these loans are usually recourse loans in the respect that if in fact that you do get upside down on the property, you personally or your estate is going to be responsible for the repayment of that mortgage debt, even if it's higher than the value of the property itself. And you know, again, 2008 taught us there's no guarantee on the home appreciation value. It's a good chance, not a good chance, but there is a chance that the home could be less given a period of time during our retirement. And of course, if somebody's 20 years old, they have a chance to recover from any downturn in the market. But we as older people don't have as much ability of the advantage of time to be able to overcome any deficit like that. Now there's a third way that you can buy a new home, and you know, only about 1% of the people in the United States even know about this. Unfortunately, it's really a hidden idea, and this involves buying your new home for as little as 50% down. This is the new H4P program, or the HECM for Purchase program, that is available to people over 62 years old. And by the time we're done here, you're going to know all about it. Now, I do want to clarify that the H4P program is for people over 62 years old, and this only applies to the monthly mortgage payment. The borrower is still going to be responsible for the cost of the homeowner's insurance, the property taxes on the property, maintaining the property, and any homeowners association fees. Again, we're only talking about the mortgage payment itself. Now, why learn about the H4P program? Well, it's a very versatile program, and one of those ways is that it just frees up cash and enables people to invest that extra money. For example, we had a recent client that was able to sell her existing home for $400,000, and she acquired a new home on a HECM loan for $400,000. So she only came out of pocket for approximately $200,000 to acquire that new home with the HECM. So she had an extra $200,000 that her investment advisor said that assuming a 4% growth rate on that $200,000 investment would yield approximately $243,330 in just 5 years. So she was able to see a return on her investment without having to service any debt. And that is a fantastic rate of return once that's taken into account. Now, people do different things in it, and people use this for different purposes, and how people use it, and that's entirely your choice. It's a free country, and you can do many different things with it, which we're going to get into here in a moment. Other things that people do, they love to take that extra money and travel with it and do the things that they've always wanted to do but haven't done. And whether they're spending the money or it's just that they don't have to service that debt, that mortgage debt anymore, is a big relief. Other things that people do with the excess money that they're not using tied up in real estate is to be able to spend it on their families in ways that perhaps they wouldn't be able to if they had the money tied up in real estate. What about establishing college funds for grandkids, helping out other relatives in major purchases that perhaps they wouldn't be able to purchase on their own and may not be able to in their whole life for one reason or another. Being able to help somebody out financially to overcome some medical problems that they might have, or just being able to give to your charity, that some people do that as well. So there's lots of versatility here. There's no right or wrong. It's just whatever suits you personally. It gives you the freedom to make these choices. Now, my promise to you guys is at the end of today's presentation, you're going to know a few things. Number one, you're going to know what the HECM for Purchase program is. Now, remember that stands for Home Equity Conversion Mortgage, and how to qualify for the H4P program. And remember that stands for HECM for Purchase program. What type of property it can be used for. And real quick, it's not just single families, but it can go into duplexes, triplexes, fourplexes, manufactured housing. Who really owns an H4P property? Hint, it's just you. And how a H4P property can be sold. Another hint, it just gets sold like every other property. Now let's look at some things that are just potentially uncomfortable when you go to sell your existing house. Number one problem you have is that you need the proceeds of the sale of that home in order to purchase the new home. And of course, there's always that period of time between closing on your existing home and acquiring the new home that have that gap of time that you're potentially out on the street for, even if it's 24 hours. The solution to that dilemma is to use the H4P program to buy your new house with as little as 50% down out of savings, which will eliminate the need to have the existing home sold. Of course, you're going to be using the other assets. Now, you wouldn't be able to do this if your existing home is encumbered by an FHA loan, because you can only have one FHA loan at a time. But assuming that you have a significant equity in your existing home, you'd be able to acquire the new property with an H4P loan. Big common problem number two is you can't really get what you want in your dream home because you're on a fixed income, can't be able to qualify for a new loan because of the reduced income that you have now versus the time when you were working. And of course, you don't want to pull all of your cash and savings out to be able to put it on the line and risk having all of those assets now tied up in a new house when you do have those assets that are already working for you. The solution to that now is that you can get what you want because you do not have to qualify for a loan because of problems that would be able to have with debt income ratios and being able to qualify on reduced income that you're on. You're able to buy more house than what you could if you were to just liquefy all of your assets and buy it, because again, you're only buying it with 50% of the value and being able to utilize that HECM for the remaining equity.
Well, what really precipitated this whole thing was I read in the dispatch about long-term health care and how expensive it is. So we were talking about it that eventually we had a 2-story large house, large yard, a lot of landscaping thing, and what was going through my mind was, if something happened to me, how is she going to be able to take care of it? So we thought, well, we'll look at a condo. Maybe that would be the way to go with it. So we started looking at some condos, and then the people we talked to said, well, are you familiar with the HECM? I said, no. Well, then they explained it to us. No, that's too good. That's too good to be true. It just makes sense to me. I was very skeptical about it. So as we talked more and more about it, then we said, okay, we're going to talk to our financial advisor, see what he thinks about it. And so we did, and they talked to him about it, and the rest is history, really. So it was great.
Now, people always ask me to be more specific about a comment that I make in regards to the down payment being about 50%. And the answer to that lies in this table right here. You can see that along the top area there, we have the age of the borrowers being 62, 65, 70, 75, 80, and 83. And along the other column, we have some numbers that give us a purchase price. Well, let's look at that teal colored numbers for 450,000 and a 70-year-old. You're able to see that the down payment there on that 70-year-old person would be $237,236. But if that same person was 62 years old, that would be a little bit higher of a down payment. And the reason for that is because of actuary tables. On the average, a 62-year-old is going to live longer than a 70-year-old, so the lender is going to require a slightly higher down payment to compensate for that period of time that most likely a 62-year-old will outlive the 70-year-old. And going to the other end of the spectrum, you can see that an 83-year-old does not have to put down as much. In fact, it's even less than the 50% that I quote, because, of course, on the average, the 83-year-old is not going to live as long as a 70 or a 62-year-old. Now, these are all based and changed upon interest rates that come up on a regular and change on a regular basis, as you can see. So in order to know what exactly works for you, you'd have to get in contact with me and find out what your property is worth, what your unique situation is, so that you'd be able to tell what your down payment is on the next property you're considering. Now the question of course, you've heard about reverse mortgages. That's what led you here today. But one of the things about the HECM program, which is different than reverse mortgages, is we're going to cover some of the history of reverse mortgages so that you'll know all about that and be able to differentiate between a reverse mortgages and a HECM for purchase loan. Now, reverse mortgages have been around since 1988. They've been around for a while, and they've evolved since then. But remember, we're not talking about reverse mortgages here today. We're talking about HECM loans. And HECM loans came into existence in October of 2008, and then they were actually enacted and started in 2009. But the history of reverse mortgages started back in 1988. Now, when reverse mortgage were first originated back in 1988, their sole idea behind them was to allow people with significant equity in their property to be able to draw money out and turn what was a illiquid asset into a liquid asset and be able to tap into that equity of their home. Now, they've evolved a lot since then. But again, reminder, we're talking about reverse mortgages here that were originated in 1988 and not the HECM loans, which were approved in October of 2008. Reverse mortgages are an incredible financial tool, and they've been a great asset for many people over the years. But unfortunately, they've suffered from some bad publicity and some, quite frankly, some incorrect publicity that's been going on out there. And it's an old story where you tell one person a story and they tell it to another person, and that goes on 5 or 6 generations down the road. Pretty soon, the story isn't the same as what it started out to be. And that's what's happened to the reverse mortgage industry by the most part. There's a lot of misinformation out there. However, that's not what we're here today to discuss. That's a discussion for another time on another subject. What we're here today to discuss is the HECM program, the Home Equity Conversion Mortgage for Purchase, or H4P. So that's going to be our focus, and not too much on the reverse mortgages. If you want more information on reverse mortgages, get a hold of me and we can go over it in more detail. Now, the HECM for Purchase program was originally passed in 2008 and enacted in January of 2009. Now, it's a variation of a reverse mortgage, but it works in the opposite way as a reverse mortgage. Now, the end result is the same, that there is no mortgage payment to be had. But to back up, we have the reverse mortgage where people have equity in their property. They are able to pull equity out of their property by either loans or have 10-year payments available on a monthly basis. Where the HECM loan is exactly the opposite, in that the purchaser or homeowner is purchasing a property using about 50% down and then not making any mortgage payment. So again, the end result is probably about the same, where in both cases the homeowner is not making a monthly mortgage payment. So why did this come about? Well, they had a 20-year history of what was going on with retirees, and they found out that a lot of them were either paying cash for their final home or getting a small mortgage, and then a couple years later they were using a reverse mortgage to pull out the cash and pay off the mortgage. That required 2 transactions and 2 sets of closing costs. So in 2008, under the Economic Housing Recovery Act, FHA signed the HECM for Purchase program, and it was launched in 2009 to allow people to accomplish the same thing with only 1 transaction. Now, let's look at a traditional mortgage. This is what we all grew up with. This is what we understand. And we know perfectly clear, if we take out a $100,000 mortgage, we're going to be making monthly payments on it for perhaps 30 years. And in the early part of the loan, it's going to be mostly interest, and the later part of the loan is going to be mostly principal. And over time, in approximately 30 years, we're going to own our house free and clear. We're not going to have any debt on it. Well, we also know that when we get to that closing of escrow, we're given a truth in lending disclosure that shows that we're going to be paying in about 2 to 3 times more in the loan amount over that 30-year period of time than what we originally even borrowed. But there's a new way of thinking now, and it's with the H4P program that we're going to be going into here today. Now let's compare that traditional loan to the H4P program, and let me attempt to try and make this easy to understand. Let's say you secure that same $100,000 mortgage, but now you've got a $200,000 property. You have no mortgage monthly mortgage payments, and your interest just simply gets added to the loan balance. By that I mean you've got that $100,000, so instead of your loan balance going down, it now goes up. So if assuming a 4% interest rate, at the end of year 1, you're going to owe $104,000. End of year 2, slightly more than $108,000, and so on. And as time goes by, that loan balance goes up. Now, who would enjoy having their home without having to make any mortgage payments? Of course, the answer is pretty simple. But this always gives rise to the question about what happens if you end up owing more money on the property than what it's worth, because that could conceivably happen. And if we were to assume, say, a 2% appreciation rate on the property itself and a 4% interest rate, it's on the average, it's going to take about 25 to 30 years before you become upside down. So what happens at that point? Well, it's a good thing to know. One of the beauties behind this is that it's an FHA non-recourse loan. And by non-recourse, we mean that you have no personal responsibility as the borrower for this. The sole security for the loan is the property itself. Your heirs, they have no personal responsibility for it. And nothing is attached to any of your other assets as far as collection or security for this loan. So it's important to note that in the event of any deficiency, somebody like Mutual of Omaha would go and collect any deficiency from the FHA. For example, let's say it's $150,000 that you owe on the property and it's worth $100,000, then of course Mutual of Omaha has the property after that $100,000 after you sell it, and then just goes and collects from the FHA insurance fund for that extra $50,000. So it makes everybody whole and everybody wins. Now, what are the qualifying issues involved in a HECM for purchase program? Well, there's not as many as a typical traditional loan because there are minimal credit requirements because, of course, there are no mortgage payments. As far as income requirements, they're not as severe because they're only qualifying you based upon what your taxes, insurance, maintenance costs, and HOA fees, because of course there's no debt to be able to service on this. There's no ratios to consider also, but that doesn't mean that there's not any paperwork. Because this is an FHA loan, we've got to document everything up one side and down the other. So if you say that you're receiving income for something and you're giving us a bank statement that says it has 6 pages and you only give us 4, unfortunately, the underwriter is probably going to come back to you and ask you for those 2 pages, even if they're blank. So those issues still apply, but we can even qualify somebody who does not have any income. If they do have assets, we can take those assets and assume that you're going to be withdrawing some of those assets to be able to take care of the taxes and insurance and maintenance on the property and pay those HOA fees. We can do it even in the absence of any income. So it's very flexible in how we can get this done. But keep in mind that because it's a government loan, FHA is involved, there's a lot of documentation that we have to go through. So how do you qualify? Well, you've got to be 62 years old or at least married to somebody who's 62 plus, and it's got to be your primary residence. So you've got to be in there 6 months out of the year or more, and you've got to have the money to close come from existing assets or a gift. In other words, you cannot borrow the down payment from another source to use as the down payment for the HECM loan. It has to come from other assets that are already existing, and those assets can include a 401k or just savings or some portfolio assets that you have. It can be a gift. Maybe you have a very good friend or a relative who is willing to give you the money and sign a statement saying that they are giving it to you and you do not have to pay it back to use as a down payment on HECM. That's permitted too. But again, these have to be sourced funds that you already have on hand or do not have to pay back in the sense of a gift. You cannot borrow the funds for a HECM loan. So what kind of property can you purchase? Well, you can either purchase one from a builder or you can purchase a second generation property. It could be a single family residence or a planned unit development. It can even be manufactured housing. It's got to be a double wide. It's got to be manufactured after 1976, and it's got to be converted to real estate. In other words, they're not going to do these HECM loans on a manufactured housing that is not permanently attached to the ground and hasn't been converted. You can do one of these on a duplex, triplex, fourplex on the condition that you are living in one of those units of that duplex, triplex, or fourplex. The loans are available on condominiums, provided that the condominium unit or project is FHA approved. If it's not, we can help you out with that. It just takes a little bit more time to close. but we can do that. As a reminder that these are both HECM and reverse mortgages. There's a maximum claim amount of $822,375. So in the event that you're looking at something that's say $900,000, they would only look at either the appraised value or the $822,375, whichever is less, and using that as a calculation for the loan. Now the biggie here, what can disqualify you? Well, naturally, if you have the federal government coming after you for one reason or another, that is going to disqualify you, because of course, if you owe money to the federal government, or they think you owe them money, you are not going to be able to qualify under the FHA insurance. If you have any foreclosures pending or a short sale in deed in lieu in the last 3 years on an FHA, VA, or USDA mortgage, again, there's a lockout period of 3 years on that, those foreclosure periods. So those are things to be careful of. In addition to, if you have any existing FHA loan in your name, you cannot have two FHA loans that are owner occupied at the same time. So that's another thing that's important. If you do, all you have to do is refinance your existing FHA loan so that you'd be able to qualify for the HECM FHA on your acquisition. So it's pretty easy to take care of. It just might even help clean things up and be able to refinance, hopefully at even a lower rate on your existing one. Now, one of the questions is, what are you responsible for? It's important to keep in mind that on a traditional mortgage, many times you are paying for the principal, interest, taxes, and insurance all wrapped up into one payment. And of course, you do not have that payments in a HECM loan. There's no payments at all. So you're going to be responsible for paying the property taxes on your own and separately from the loan. You're also going to be responsible for paying your own homeowner's insurance and or homeowners association dues on your own, because again, those are not wrapped up. You're not making any payments to the lender. You're responsible for the general upkeep and the maintenance of the home. And by this, I don't mean that somebody's going to come by and make sure that you're mowing your yard. We're talking about keeping the property insured, and if a tree falls into your house, hire a contractor and get it fixed and use your insurance to make those repairs. It's important. That's the main stuff they're looking at. They're not wondering if you took your Christmas tree lights down or not. They're just looking at the major upkeep and maintenance of the property itself. The simple answer to this one is how long can you live in the house is, well, quite frankly, it's till the day you die or move out. And that goes for all borrowing spouses that are in that property. In this situation, to be more specific, you have a husband who passes on. The wife is able to stay there living until the day she dies. It does not create an acceleration on the loan and cause it to be sold. It doesn't trigger that. And it also applies if the borrowing, it doesn't have to be a spouse. It could be a mother and daughter, a father and daughter. It could be one of those combinations of any of those. As long as one surviving spouse is still inside there, that's not going to cause or trigger any acceleration of the loan. Now, there was just a change here recently. It has to do with non-borrowing spouses. By that, I mean, we've said that these loans are only available for people over 62, but many people who say 62 and has a 58-year-old spouse, what happens then? They turn 63, and 1 year down the road, they die for one reason or another. What happens to that surviving non-borrowing spouse? Well, according to the new changes that just came out in May of 2021, that non-borrowing spouse can remain in the property until the day that they die or move out of the property as well. So it's been a great change that makes it a lot more flexible and a lot more attractive on the HECM side. So it's really something to look into, and I don't know, I can't speak highly enough about this stuff. So what happens if one spouse is 62 and the other 68? What age do you use in calculating the down payment? That's right, it's the 62, because the 62-year-old is most likely, according to tables, is going to live longer and stay in the property longer, so that's the number that is being used. So what if one person is 62 and the other is 58? Well, what number would they use? That's right, it's the 58. But unfortunately, because they're going to be using that 58 number, the amount of money that you're going to be able to borrow is going to be far less than somebody who's 62. Now, what happens to the borrower, the younger spouse, in the event of the death or the older spouse is relocated to an assisted living facility? Well, again, you're right. The non-borrowing spouse is what we call it, because they're under the age of 62. They're not on the borrowing. The younger spouse is not required to refinance the loan, and that younger spouse can remain in the property for the rest of their lives. They do not have to requalify or pay off that loan simply because they were a non-borrowing spouse. That doesn't mean that they do not have to pay the property taxes or insurance. They still have to do that, and they still have to live in the property. They can't be a separated spouse. Now, let's take this a step further. Let's say that one person is 62 and the other one is 58 and they are not married. Well, if they're not married, then the 58-year-old could not be entitled to the property. However, they could stay living there. That's not an issue. But that 58-year-old would have to sign a statement saying that they are aware that the 62-year-old, if they happen to vacate the property for more than 12 months, then the loan would become due and payable. And that would be a requirement of the loan. Now, take this another little step further. We've been talking a lot about married couples, but in the instance of, let's say that there was a mother and daughter and they were both over 62, they can both be borrowing spouses on the loan and hold the title and work it just as if they were a married couple, because they are both borrowing spouses. The instance we're talking about right here on this slide has to do with a non-married couple, with one of them is 58 years old. So I hope that clarifies that. So who owns title to the home? The quick answer is you do. Not FHA, not Mutual of Omaha, not any other government agency. The simple answer is there's no difference between home ownership and title on a HECM loan than there is on any other loan. Of course, you still have to keep current on your taxes and insurance, just like on a normal loan, and you just have to keep the general repairs maintained. The difference is that this has to be a primary residence, but the home can never be taken away for any other reason. You are able to sell this property just the same way. For example, let's say 5 years down the road, you want to be able to sell it and move someplace else for whatever reason. You just simply get a loan payoff statement from Mutual of Omaha or whoever the lender is, get it paid off, and you just pays off for whatever you owe it for, and you take your equity and you go move someplace else. There's no difference. So what happens when both borrowers die? Simple answer is there's no difference here on a HECM loan than there is on a traditional loan. The house is left to the estate and be settled in the exact same way as any other estate with a house. It always can be decided if the house is going to be bought or sold by a family member in the same way. An appraised value is always determined, and the house can be sold for market value. At the time of the sale, if the sale price exceeds the mortgage balance, any difference will go to the estate. For example, if the loan payoff is $300,000 and the value of the property is $400,000, then $100,000 goes to your estate and goes to your heirs, just in the same way as a traditional loan. Now, the estate would not be responsible for any deficit. For example, let's say that the house is worth that $400,000, but the loan balance is $500,000. Well, the estate, your heirs, you, anything you own, is not responsible for that $100,000 deficit. The FHA insurance would pay the lender, Mutual of Omaha, that difference, $100,000 between the actual value and the loan balance itself. Another question that seems to pop up quite a bit is the apprehension that asking the question, is this another way of the government getting itself in trouble, much the way it got in trouble back prior to 2008 with the no document loans? And the answer is no. This is not a taxpayer funded program, and every person that does an FHA loan contributes to this fund. And this goes back to, well, longer than most of us have been alive. I think it's somewhere back just after the Depression. It pays into this FHA fund to secure and keep it secured. Taxpayer dollars have nothing to do with it. And in the case of regular FHA loans, the borrower's payment always has a certain percentage of it that goes into the FHA insurance fund. But the difference with HECM, of course, since you do not have a monthly payment, the borrower, you, would be paying a 0.5% per year of the loan balance towards this purchase, this FHA loan. This creates a continuous stream of dollars to fund the insurance program and make sure that it's financially solvent. So again, just to recap, this is not a taxpayer-funded program, and everybody has been paying into it for all types of FHA loan, not just HECM, but all types of FHA loans are being funded here. So the borrower on a regular FHA, as some of you might be aware, is some of your payment every month is going towards that FHA fund to keep it solvent. But in the case of the FHA, the HECM, excuse me, the lender needs that 50% paid in every year towards the balance, because the lender is paying that, so it gets tagged on to the loan amount, and it's part of that amortization schedule that keeps growing over a period of time. Since the borrower is not tagged into a monthly payment, the lender is making the payment, and it gets tagged on to the unpaid balance of the loan. So what are the closing costs? Well, they're similar to what's on a normal forward FHA loan. The origination fee is usually, it's always capped at $6,000, but it could be as little as $2,500 depending upon where you are at with that $200,000 loan. So there's a little bit of a calculation there, but generally speaking, it's a $6,000 in the Las Vegas metropolitan area anyway. Of course, third-party costs still apply. We still have the title fees, appraisal fees, recording and title insurance are all still applicable, just as a forward loan is 10. Now, you don't add on these closing costs to the down payment matrix. Remember earlier I showed you that matrix that said if you're 70 years old, here's what you had to pay. If you're 62, you pay a little bit more. Well, that down payment and that amount includes these closing costs. So you do not add these closing costs to that down payment matrix. Those are taken care of at closing. So if that matrix says you're supposed to come to your loan balance is going to be 227, that's what you need to come in with. These costs can be added on to the loan. And of course, there's always a deviation in there for a fudge factor on those numbers, and it could reflect as much as $1,500, give or take one way or the other. So if you're building a new house or you're buying a new house that's under construction, how does the financing work? Well, because this is a federally insured program, we cannot order the appraisal until the certificate of occupancy is issued. So they have to be finished with the construction before the appraisal is finalized. Now, that means that it is going to take an additional 15 to 20 days after the house is finished before you'd be able to close escrow and move into it. So it's always important, if you're going to be, if the property is finished construction, say November 1, you really don't want to call for a close of escrow until November 20th, just to be on the safe side. So how long does this process take? The short answer is about 30 days. I think the variable on that is appraisal times. How long is it going to take an appraiser to get out to a property? Right now, as I'm making this recording, appraisers are really darn busy, and getting them to go out into a rural area is usually taking a little bit more time and money to get that done. The next one is, who brings money to the table? The short answer is no difference again between a HECM loan and a regular loan, where the borrower brings in the down payment and the lender brings in the balance. And at a given time, the escrow officer or attorney then distributes that funds to the seller and or the lien holders on the property. Now, the next question is one that has a lot of confusion behind it, and that is in regards to being upside down on the loan. In other words, you end up owing more money on the property than what it's worth. What happens? Well, in the perfect situation, you're still living there and you still owe more money on it than what it's worth, and it doesn't matter because you're not making a mortgage payment anyway. But it's important to note that if you were to move on from the house, and I say that politely, if you were going to be no longer in the property, and your heirs were to inherit that property, your estate is not responsible for any deficit, nor are your heirs responsible for any deficit. It's important to remember that this is an FHA loan that is non-recourse. In other words, the lender, let's say it's Mutual of Omaha, does not have the ability to go after you for any deficit that occurs between what the property is worth and what is owed on it. And if that situation was to arise, the Mutual of Omaha would just then go to the FHA fund and be paid any deficit from that FHA loan. Now, question always comes up, how long would it take to get upside down in the market? Well, if we use existing interest rates and we assume that there's a 2.5% appreciation per year, it would take still about 25 to 30 years for the average loan to become upside down. So there's really not too much to worry about there. And we always have to focus on what we're getting, and that this is a negatively amortized loan, but it is an FHA loan and it is non-recourse. So again, you do not have any responsibility for any deficit, nor do your heirs. The sole security for the loan is the property itself. Now, another question that pops up is, let's say, for example, you originate one of these HECM loans and you move into the property, and for some reason or another down the road, you decide to move. So the question is, can you sell that existing property and put a HECM loan on a second property? And the answer is yes. You could do that, of course, with the same qualifying techniques that are used in the first loan. You have to use it as your primary residence and such. But kind of a caveat to that is that you must sell your existing property that you have the HECM on before you can originate a second FHA HECM. So you cannot have two of these loans going at the same time. Another question is the rates fixed or variable? And the answer to that is that they can be either one. They can be fixed or they can be a variable. The fixed rate has slightly higher interest rates, and the variable rates, you have choices. You can do annual adjustments, you can do monthly adjustments. There's a choice between a different caps on the interest rates on those variables. So you can choose to have a lower entry point or a higher entry point and have a little bit more stable interest rates. But from my experience, a lot of people will just go ahead and look along that bottom line and see which one costs them the less or nothing to get into, and that's their choice, because of course they're not going to be making any monthly payments on this loan whatsoever until the day that they move out of the house or move into an assisted living facility. So I'm frequently asked the question is, this sounds another thing of too good to be true, and how does the lender make money off this? Well, we go back to the normal traditional mortgage, and as you know, you borrow money and you pay interest on it. They make money on the interest. They get paid on a monthly basis. But the HECM is a little bit different, and that the interest is still being charged, but it's just being accruing on the loan balance, and which causes the loan balance to grow over time rather than reduce. So it's more of a long-term play for the lender to be able to get repaid back. But again, they always feel comfortable being paid back because there's that FHA insurance attached to it. So they know if the estate, if the property is not able to repay that loan, they're able to then collect on that FHA insurance. So the money the bank lender doesn't get paid back until the house is sold, but they always end up getting paid, whether it is from the proceeds of the sale or the collection of the FHA. So once again, the benefit of this program is that the borrower, you, are not responsible for paying back this debt. Keep in mind, it's referred to as a non-recourse loan. In other words, non-recourse on you. The only recourse that the lender has is on the property itself, and not on you, not on your estate, not any of your other assets. But of course, the normal disclaimer on that is you must occupy the home as a primary residence, keep property taxes and insurance current. Now, does your existing home have anything to do with this transaction of using a HECM to acquire a new property? The short answer is no, it has nothing to do with it. It's a totally separate transaction, and you can originate a HECM with existing funds. You do not have to sell your existing primary residence unless, of course, you had an FHA loan on it, because remember, you can't have two FHA loans at the same time. Now, where we get into some confusion, people call this reverse mortgage. It creates confusion because some people start thinking that you're going to use your existing home and use equity in it to buy a new home, and that's not the case. They're two totally separate things. The HECM for Purchase program is totally separate, has nothing to do with your existing home. Your existing home stays completely out of it. Another question I think we might have covered before is, are you or your heirs personally liable for the debt? The answer again is no, no, no. If your heirs would like to keep the home instead of selling it, the loan must be paid off, but they'll never be required to pay more than the full loan balance or 95% of the home's appraised value, whichever is less. And if it isn't, in fact, it's upside down, they meaning the lender, Mutual of Omaha or whoever the lender is, will not be coming after you. They will not be going after your assets. They will not be going after your heirs for that repayment of that deficit. It will be reimbursed from the FHA to the lender. So what we most often hear here at this point is that sounds too good to be true, and where's the catch? Well, let's go over those catches. How old do you have to be? 62. And what type of residence does it have to be? Primary residence. And how much cash do you need at closing? Where does it need to come from? Well, it has to be from liquidation of existing debt. It cannot be borrowed money. Can it be a gift? Yes, but again, it cannot be borrowed money. Who's on title? It's you, and it's only you, not the government, not the lender, not FHA. There's no difference in title when it comes to ownership from in a reverse HECM situation and a forward loan. You are on title, it's only you. Now, can you sell at any time? Yes, of course. There's no prepayment on an FHA loan, and that extends on over to HECM. You can sell at any time you want, and if there's any profit on the sale, you are the only one that's going to participate in that profit. Not the government, not the lender. It's only you who have the title on the property. The HECM loan is just a lien on the property. It is not ownership at all. And the next one is, who's responsible for an upside deficit? Are you? The answer is no. Remember, it's the FHA. And at closing, you have that 2% FHA insurance at closing, and then 0.5% of the ongoing balance thereafter. So if you have a $100,000 loan, it's going to be a $500 a year expense that's added on to the loan on an annual basis. And of course, the loan increases by the interest and the FHA charges on a monthly basis. If there's a time where you want to sell the house, you just go ahead and contact the lender, Mutual of Omaha, and get a payoff statement. They will give you that payoff statement. You sell the house just in the same manner as if you had a forward loan on it. And when it comes to getting upside down, it'll take the question gets asked is, how long would it take to get upside down? That's a tough one to answer because it depends upon where in history you're at, and what the interest rates are. But at the current environment, assuming a 2.5% appreciation rate, you're looking at about 25 to 30 years on the given variables that we have in front of us at this time.
My first reaction was very much what was in your brochure, and that is, it sounds too good to be true. So there has to be some snag, there has to be some hidden pitfalls in this that I'm not seeing, even though I consider myself a financial guy. And so I kept thinking that the other foot's going to drop and there's going to be something here that just doesn't add up. But I went through the whole process, and it ended up being one of those things in life where it was too good to be true, but it actually panned out just as I was led to believe it was going to. Well, now that we're moved in, to me it's like it's given us a security blanket of knowing that we can live in this house forever. If the housing market crashes like it did in 2008 and for the ensuing few years, we know that we don't have to worry about ever being upside down on a mortgage from the standpoint of losing a house or whatnot. We are protected on the downside and still could benefit on the upside if there's appreciation in the house going forward. I did look at it through traditional financing, and it's interesting because in the last 5 or 6 years, my whole view of home ownership has changed dramatically because of what's happened in the housing market. Throughout my entire life, we always thought you buy a house, it'll continue to appreciate, you go to sell your house and you're going to have all this equity in it. Well, in the last 5 years, 6 years, a lot of people haven't experienced that because their equity went down the tubes. So that's started changing my view of things. And then I started thinking, well, okay, I might want to take a different view of a negative amortization versus a traditional fixed financing program like we've always done. And if you start running the numbers and running them side by side, you'll find that through this program, you can actually come out ahead as opposed to a fixed financing program. And without getting into all the specifics of that, the numbers do work out. And of course, you can make different assumptions for whether or not the house is going to appreciate or not appreciate, etc. But again, a key point to me was if the housing market goes through a period where it stops appreciating, actually goes the other way, you are protected in this program, whereas a fixed financing instrument, you are not protected, as so many people found out.
Now, does anybody listening to this call want to make a monthly mortgage payment during your retirement years? That's a silly question. Now, of course, most people are going to say no to that question. And what's one way you can live out your dreams and not make a mortgage payment? Well, you can always pay cash, right? But now you can use all your cash and not have it tied up in bricks or mortar and the actual structure itself. You'd be able to use your money the way you see fit. And if you invest it, it's going to be growing. And if it's just sitting in a property, it's not growing. Now, you have an incredible option that allows you to put a minimum amount of money down and keep the balance and let you grow. This puts you in a position of only knowing about what perhaps 1% of people out there know about. You might ask why, but remember, it's only been around for the HECM has only been around for about 12 years, even though reverse mortgages have been around for much longer, since 1988. But the HECM has only been around for 12 years. And by the most part, local banks don't offer this product because it's a niche product. It's really just for people over 62 years old. It's not advertised, so most people don't believe it's true and have some apprehensions about it because they don't have all the information. Now you have all this information. You're one of the few people. Now, I'd like for you to get a copy of the Home Buyer's Guide and turn to page 11. You'll see that there's a comparison between two couples. One couple is buying with a 20% down on a conventional, and the other one's buying a property with HECM. Both properties are worth a purchase price of $350,000. The people that buy it with a 20% down on the conventional, and they're going to be making payments of $1,503 a month, over 30 years, they're going to pay out over $611,000 towards the purchase of that house. Where on the HECM loan, they're going to put down $180,000. And in that scenario, if they took that same $1,503 and gave it to their financial advisor and got a 4% compounded growth, you know what that would end up being? About over $1 million in value. Now, who's in a better position? The people who bought the conventional loan or the people who used the HECM to buy? The answer is pretty simple. And what heirs benefited the most from those transactions? Obviously, was the people who used the HECM to buy it. They came out financially ahead over the couple that used the conventional loan and had that monthly payment. There's no right or wrong here. It's always a matter of what we do with our money. We don't put in a house, and the money that we invest. And it really depends upon, excuse me, what we do with our freed up cash. So at the end of the day, that is what matters. Final word of caution. You know, if you're like me, you hear about this program and you want to stand on the tallest mountain and just tell everybody about it. But the fact is, you cannot explain this program in one or two sentences and get people to understand it. You are one of the few people, because you've listened to this program now for all this time, know the ins and outs of it. And there's so much bad information out there. And I've talked to some certified financial planners who have given out bad information. I'm not saying that they're not qualified, but there are a lot of people out there who are giving out bad information. You now have the information that's correct, and it's been verified through my superiors in listening to this video as well to make sure that everything that I've said here is truthful. And again, you just cannot tell somebody what this program is in one or two sentences. They're going to say you're crazy. They're going to get confused with this between a HECM loan and a reverse mortgage, and search the internet and see all these things that are bad with it and instantly disqualify you and or anything that's said in here without listening to the entire presentation and understanding the full program. So be careful about who you're talking with, and be able to share the guide, the homeowner's guide, and or share this video with them so that they can fully understand it and judge it accordingly. Well, what's the next step? Is to schedule a meeting with me to get an approval letter. And I can't stress this enough, because especially in today's hot market, where if you trying to buy a house on a contingent upon the sale of your existing house, it's going to be a little bit more difficult to get that deal on. If we have if you're able to use your existing realtor and have an actual approval for loan, just subject to appraisal of the existing property, it makes it their job far more easier and able to get your offer accepted. And if you're working with a realtor, make sure you have them contact me to learn about the unique aspects of a purchase contract with using a HECM. Most realtors out there are unfamiliar or not very well versed when it comes to how to write a purchase contract in using a HECM loan. So it's important to have them up to date too. This is going to help you find the home that you're looking for. You can contact me in part of this approval letter. We're going to run some existing numbers to find out what the purchase price you're looking for based upon the younger age of the borrower, and be able to give you an amortization schedule showing some assumptions on what your loan balance is going to be and what your valuation is going to be, assuming say a 2.5% appreciation rate over a 20-30 year period of time. Once we have that in place and you have that approval letter and you found the home, you'll be able to complete the purchase contract with your agent or yourself and be able to move on. Schedule a time to meet with me so that we can get started and review the entire process and get you moving forward.
While I was